afraid of investing? It feels risky, right? Whether it's investing in property or investing in the stock market. And it's true for somebody who is uneducated, there is a risk. And there's always a risk, even if you are educated, but you're more aware of them. But the real risk is actually leaving your money sitting in a bank account and not doing anything. That's a bigger risk than whether the stock market rises and falls or what house prices do, whether they rise or fall. Why is that? Because of inflation. And I've mentioned it to you before. Inflation is this virus that nibbles at the edge of your savings so that if you're not conscious about what you're doing, in real terms, your money will be less, even though you have thought that you have saved for years and years. So, in this episode, I'm going to break down how to start investing without the fear, to tackle why people hesitate, to look at the hidden cost of playing it safe, and to give you some low risk ways to start your investment journey today. So, over to me in a minute. Hello and welcome to A Wealthy Life. As you know, my name is Vicky Washay, and while I'm not a financial advisor, I have been investing in property in excess of 20 years, and I have over the years had stocks and shares in different forms, from individual company shares through to investment portfolios. And I would say, ironically, that I didn't feel worried about investing in property, and I'm not completely sure why. I think for me, there was more control. I could buy the house, I would own the asset. It was a physical thing that I could touch, and I understood the maths a lot easier. It was a lot more straightforward. There are market forces at play. The supply and demand of the property would affect the price or increases and reductions in rent. And I immediately understood that we live on an island with planning regulations the way they are, particularly if you think back 20 years, that meant that housing was always going to be something that there was a pressure on, if not least for the fact that we had limited floor space to keep building on and that we were going to have to just go higher and higher, which is why you see a lot of city centres are full of such enormous tower blocks of properties. So I could see the maths on that a lot easier. For me, it was a lot harder journey to get into stocks and shares and investing. And again, that was about a control issue. That was to do with, well, hold on a second, I'm effectively going to be giving some of my money to another company, because that's what you're doing. When you buy one of the shares, you're effectively investing in that company by giving them money, and they're giving you a share of their profit. But I've got nothing tangible, nothing that I can touch. I mean, I could probably go and stroke Marks and Spencer's or Tesco's, and I'd have to go quite a way to find an oil rig or something like that. But nothing really tangible, and certainly nothing I could influence, because with the tiny proportion of shares that I had of all the shares that company issued, my ability to even show up at a shareholder meeting and cast a vote that would make a difference was minuscule. And so what I had to really do is deal with the risk that I felt like, what if I put my money into stocks and shares and those stocks were affected? And the only way that I could address this is to learn more, to understand, very much like property, any investment, I'm going to say to you, unless you're trading. Now, just to clear up, trading is when you buy and sell on a regular basis. If what you think you're going to do is invest in stocks and shares or invest in property and you're planning to sell it out, and I'm going to go within 5 years, okay? You might not be a day trader, but you are a trader, a stock trader or a property trader. Because actually people who invest in stocks and shares and property for the long term are doing it for 10, 15, 20, 30, 40 years out. I'm already at the 20-year mark. I may well get to 60 years that my portfolio has been running before I am maybe not ready to retire, but certainly thinking about, gosh, look back, I've been investing in property for 60 years. And I will have benefited from monthly rent coming in, which is my profit from the rent minus the expenses. And I will have undoubtedly benefited from the rise of prices. If you just think back to house prices 20 years ago and then think back to house prices 40 years ago, you start to understand the capital gains. Now, you can do that with the stock market as well. You can go back and look at historical data for how the stock market has performed. But what you will see is there are a lot of ups and downs. And what you need to do is to manage your risk. If you're going to panic when that loss comes, when it apparently on paper, because frankly, nothing really has changed, but on paper, your shares are now worth less, do not sell. Do not crystallize that debt. Do not crystallize that loss. That is your biggest mistake. So are you courageous enough? Are you brave enough? Do you understand enough to start investing in stocks and shares? So let's just talk about this thing of why people hesitate to invest in more detail and probably how to shift your mindset around it. I've already said this on a number of occasions. It's a lack of knowledge and understanding, thinking it's too complicated. But there are good teachers out there. There are videos these days, maybe slightly less checking out Instagram 1 minute reels. Find a good teacher, and I will help educate you or direct you to trusted practitioners, people actually doing it rather than just selling courses. You just have to ask. So get the knowledge first. And then once you understand whatever it is that you're thinking of investing in, you've then got to almost go inside and check out how you feel about it. Because this fear of losing money either stops you gaining wealth generally, stops you from investing completely, or can allow you to make really bad decisions, causing you to lose money. You lose money by exiting anything at the wrong time. You only want to ever exit when your asset is at the peak. But of course, it can cause you to panic if you see the stock market crashing. And of course, you've got to understand that unless you're managing your savings, as I spoke to you before, you could already be losing money to inflation anyway. You need to really think of investing like planting a tree. The sooner you start, the stronger it will go. The sooner you start, the sooner it will start to fruit. So, do you understand why you are hesitant about investing? How could you score yourself, rate yourself? Is it about your knowledge and understanding? Is it about fear, which I will still bring you back to the point that that is a lack of knowledge? Are you naturally risk averse? So is it to do with your values? Is it to do with how you approach risk? Now, education can help you with that. Certainly from a property point of view, I have identified the risks to my own portfolio and that of my clients, and then put in place steps to manage or mitigate that risk so that it becomes minimal or non-existent, depending on what the risk was. You can do that with the stock market as well. So what is stopping you? Understanding that is the first step, because you can't address that unless you know what the problem is. And let's just tackle again. I am going to constantly bang this home to you because some people will need to hear this once, some people will need to hear it 4, 5, 6 times. There is a cost to playing it safe. So while we're talking about risk, one of the risks is playing it safe because of inflation. So I've already said to you that if inflation is at 2 or 3% and you are just leaving your money in a simple bank account, you might find that your bank account, I looked up, I think it was Barclays, could be other accounts, could be other banks, but I just saw the stats for Barclays that Barclays was paying on a current account 0.76% interest. Well, you can already see that if inflation is at 2%, just to make the maths nice, everything is costing you 2% more, but your money is only growing by less than 1%. Surely you can understand how your pot is shrinking day on day, month on month, year on year, you are going to be losing purchasing power over time. And the more that this goes on, the bigger it compounds. I even made the mistake just after COVID where I wasn't paying attention to the bank accounts because we were busy doing everything else, including spending time in the garden. I took my eye off of my credit accounts. I allowed my current accounts to accrue money. I just kept the money in there. I didn't move it to another savings account. And in that time, we had inflation. And in that time, my savings in my current accounts were not earning money. And I could have been getting 5 or 6% in a higher rate savings account at the time. I lost nearly 5% interest on my money over that period, over the number of a couple of years. And that's why I want you to check out how much your savings are earning, because it can make a massive difference down the line as it compounds. It's not just about always making money. It's about making sure that the money that you make is keeping up with inflation and making money in its own right, compounding. And then there are low cost ways that you can start investing. Yes, getting into property, you're going to be looking at in the region of £60,000 per property by the time you've paid for your deposit and your solicitors and your surveys and your stamp duties and your refurbishments and everything else that goes with buying a property. But with that, I'm currently getting around 8% net return on my money. So if you do have more money to invest, then that is something that you could seriously look at. Obviously, get in touch. But if you have smaller amounts of savings, there are different ways that you can address this. This is not financial advice. This is signposting things that you need to research for yourself or get financial advice on. So if you have savings in the region of, say, 20 to 30,000 pounds, what you could be looking at is ISAs. We've spoken about these before. It is basically a savings account, but the difference between a regular savings account and an ISA is that any interest that you earn on an ISA is tax-free up to £20,000 worth of investment in a year. There are two different ways that you can go. You can go all cash, which is just like a regular savings account, or you can have an ISA savings account, which is about putting your money into the stock market, typically in some sort of mixed fund. So now what you need to think about is how much money have you got to invest and where's the best place for it? If you're looking at less than £20,000 worth of current savings or the ability to save that a year, then you could still use an ISA, absolutely. But the priority for you has to be the highest interest you can get for this fixed period for the long term. When I talk to you in the Smart Woman's Ultimate Guide to Money and Investing, I talk about having different saving pots for different reasons, but all of them need to be high interest. Now, you can Google the rates. I use a company called Raisin, which is just another bank, but as a gateway bank, it then taps you into lots of other savings that you can get into. They are all protected by the UK guarantee up to £85,000, and that's really important to pay attention to. But what I found by looking at Raisin is that at the moment, it is easier to put your money in a limited notice account and get better rate of interest than it is to put it away for an entire year. So thinking that you put it away for longer does not mean that the interest rate will be better. And that's all to do with their economics. What they're doing is they're gambling on what they think the Bank of England base rate will be in the future. It's a sure sign that they think that interest rates are coming down, because if interest rates come down, then savings rates come down. So what you've got to look at is how much money you've got. At the very least, make sure that you know the interest that you are earning on your savings accounts that you have now. And if you're not looking at something like 4% at the moment, I think you need to do some research and you need to find somewhere else to move them. Do not, under any circumstances, withdraw money from an ISA. They need to be transferred And that's why you've got to have a bit of education behind you to understand. I have spoken to hundreds of women who over the years have been drawing their money out of a high rate ISA account and then putting it into another one and losing the compounding benefit of the 20-year allowance. Because what ISAs do for you is they let you have £20,000 worth of savings in year one. And if you transfer it properly, you can add another 20,000 in year two and have 40,000, and transfer it properly, and you can have another 20,000 in year three. And then all of a sudden, you've got £60,000 all earning interest that is tax-free. And that's the compounding and the benefit of a little bit of education and knowing what you're doing. So you can start with high interest savings accounts. You can start with either stocks and shares or cash ISAs. You might decide to invest in a low index fund, or if property aligns with your financial goals, you might start to invest in property. But whatever you do, look to start now and understand that there are risks and that it's about long-term growth. What you're looking to do is put your money in and watch it grow. Investing is never about getting rich overnight, no matter what they tell you. It's absolutely about building long-term financial security for your future, becoming resilient so that no matter what happens to you, you will be okay financially. And ultimately, the best way to deal with fear, of course, is knowledge. And that's why, as I said, I've got this 4-hour completely free video on YouTube. Enough about that now. You can read more about it in the links. But whatever you do, I want you to be taking control of your money. Thank you very much for listening. And I hope that you've been able to get at least 3 whooshes out of this podcast to understand why you might be hesitating, to understand how you can overcome your fear, to know the cost of playing it safe. And then I've even given you action points on how you can move forward and start saving for yourself in a cost-effective, long-term way. So, as I've said, thank you very much for listening, and please subscribe. Go and check out the video on YouTube, and I'll speak to you next week, where we're going to focus in on specifically the confidence gap between men and women and why women are less confident with money. Very best wishes. My name's Vicky Wushay.